Hey everybody, how's it going? It's Russell Matthews here, and if you have any money in a savings account or a checkings account, it's very likely that this money is losing value every day you keep it there. And no, I'm not talking about service fees or transaction fees that can make your bank balance go down. No, I'm talking about something that's totally invisible and that you can't see when you look at your account. And despite the fact that this is pretty much invisible to the everyday Canadian, you're slowly losing the ability to purchase things of value with the money you already have. If you haven't guessed already, the reason this is happening is inflation. And this is just a term to describe how the things that we buy in our everyday lives are slowly increasing in value, and as a result, the dollars that we use are going down in value because with the same amount of money, you can purchase less. So in today's video, we're going to talk about some new data that has recently come out that shows that inflation is on the rise in Canada. And we'll talk about how this impacts you specifically, whether or not it's a good thing or a bad thing, and how you can protect the money you already have. After all, this is a channel about Canadians and their money, bringing you updates and news and information about how you can build a more financially stable future for you and your family. So if you want to stay up to date about changes that are happening to your money and how you can specifically take advantage of it, then you're going to want to hit all those buttons down there, like, subscribe, notification bell, all that good stuff, because I'm bringing updates just like this one all the time, so you're bound to learn something that can help you and your family and your financial future. But with all of that said, let's take a look at this new data that's out that's showing that inflation is on the rise in Canada and how it can affect you specifically. So here's the headline that was reported in the Financial Post. It says, food prices drive Canada's inflation rate higher than expected as the price of lettuce skyrockets. Okay, that's an interesting headline. But how does the price of lettuce affect inflation? Well, to understand that, we need to understand something that's called a CPI, and that stands for the Consumer Price Index. This CPI, or Consumer Price Index, is the most common way that people will measure how high our inflation rate is. And it works like this. Imagine that the CPI is a basket that you're carrying around at a grocery store. As you walk around the store, you take some of the most common items that you're going to need for your day-to-day and you put it inside of the basket. At the end of your shopping trip, you'll take this basket to the front counter and see how much it costs. Now, if you get the same thing over and over again over time, you'll be able to see a little bit of a change between how much you're paying for this exact same basket on one day versus the other. And that's exactly what the CPI, or Consumer Price Index, is. It's a number that tracks the overall cost of some of the most common items that Canadians are having to buy on a regular basis. When the cost of this CPI basket goes up, it means that inflation is going up, because with the same amount of money, you're now able to buy less, or you have to use more money to buy that same basket that you bought for a few bucks less a few months ago. Right now, you're probably thinking that anytime there's inflation, this is generally a bad thing. I mean, it kind of sucks to have to spend more money today than you did yesterday to buy the same thing. But there's actually a small amount of inflation that is a good sign for the overall economy. Let me explain why. To make things simple, a sign of a healthy economy is that a lot of people want to buy things and they're willing to spend their money to buy these things. As more and more people want to buy things, the price of those things will go up. You'll remember if you've ever heard the supply and demand concept. When more and more people want to buy something, the price of it is obviously going to go up a little bit. When that demand goes up, companies and businesses are incentivized to make more of that thing. And how do you make more of something? You have to hire people to either work the machines or do the labor that it takes to produce that item or good. The idea is that this creates more and better jobs for the very people who are going to go out there and spend money, and the cycle continues. So we want to see a little bit of growth in the economy and a little bit of growth in our inflation to show that this is on a positive trend. More jobs are being created. People are still spending money. These are all generally good things when we're evaluating how healthy the economy is. As of right now, the Bank of Canada has claimed that its target is 2% for inflation. So in their minds, that basket of goods, the CPI, would go up in price at a rate of 2% every single year when compared to the last one. So if you spent $100 on this basket last year, now you'd be spending $102, and that would be a sign of a healthy growing economy. But things tend to get a little bit off the rails when you don't hit this mark. If you have inflation that's too high or too low, both of these things can result in negative impacts for the everyday Canadian. When inflation is too high and things are getting very, very expensive to buy, generally wages won't go up at the same time, so people won't have enough money to buy the products as inflation increases. And that's especially the case if you have money sitting in a savings account or a checkings account. There's nothing that's protecting that money from inflation. If you see the price of things go up way more, that money that you've saved can buy you way less. And remember, later in this video, we're going to talk about how you can protect yourself from this happening to you. Now, on the other hand, low inflation isn't all that great either. Just like I was explaining in that example where a little bit of growth in inflation is a good thing because it can create jobs and increase wages, the inverse is also true about low inflation. That would signal that not a lot of people want to buy products, and it could result in less jobs and lower wages. And if things went even farther down that road, we'd actually see deflation, where the price of your everyday goods would go down. Now, this might sound like a good thing initially, but if the price of these things that you're buying is constantly going down, like say you want to buy a washing machine and you see that every single month it's going down by a little bit, you'd be incentivized not to buy that product, thinking that, oh, I can just buy it when it's a little bit cheaper next month. This causes a chain reaction that can have a really negative effect on the economy if nobody's buying any products. This graph is actually super easy to understand. It just shows us on a month-to-month basis how much inflation there is when compared to last year, and it shows us this in a percentage. So you'll see here around January 2020, we had inflation of 2.4%, which is pretty close to the target that the Bank of Canada wants for a healthy economy of 2%. But you'll see right here, when COVID hits, this kind of goes down. In April and in May, we saw deflation, so that price of goods, the CPI, went down because less people were buying. Again, sounds like a good thing if you're a consumer trying to buy, but in terms of the overall economy and jobs that you could be trying to get, this is a bad thing. We did see a little bit of growth, and then it went back down here, and now we're seeing it grow again, which is a good thing. You can sort of start to see that it looks like we're on a trend to get closer to that 2% inflation mark that we think is a good representation of a healthy economy. But it seems like it's a little bit debated on why this percentage went up this time, because it looks like it's just in a couple categories that have really driven this rate up, and we've actually seen some losses in other categories. So that's a video for another time though. But what does this mean for you and the money that you have saved? Well, we know that the Bank of Canada is targeting that 2% rate to have a healthy economy. So for the long term, we can expect that the Bank of Canada is going to change its monetary policy to try to push that rate to that 2% as frequently as it possibly can. So if this is the case and you have $1,000 in your savings account and you're just holding it there and you're going to hold it for the long term, maybe you're saving it for your retirement, then that means that over time, every year, that will decrease in value 2%. Let's say you held that money for 10 years and you weren't earning any interest on it. And we'll also assume that this inflation rate is going to be somewhere close to 2% over the course of those 10 years. In terms of value, that $1,000 from 10 years ago would only be worth $817 when compared to what you can use it for to buy. Looked at from the other direction, something that costed $1,000 10 years ago would now cost $1,218. So you wouldn't be able to use that $1,000 to buy as much. This is why there's the stereotype of the old person saying, oh, back in my day, chocolate bars only costed a nickel. This is evidence of inflation. That nickel over time has increased to the $2 or $3 we're paying today for a chocolate bar. But luckily, there is a way that you can protect your money against losing this much value over time. And the best way to do this is to invest that money, either in something that will pay you back interest or will increase in value over time. Now, at times in the past, you would have been able to get a savings account that had a decently high interest rate that might be able to outpace inflation. But now in Canada, it's more and more rare to see high interest rates in savings accounts. So people are turning more and more to investments like stocks or ETFs. These are things that you can put your money into for the long term, and generally they're going to grow over the long term, as long as you hold them for the long term. This is why investors love investing, because it protects their money from losing value over time, and it can actually outpace outpace this inflation, so they're making money on top of just protecting the value that it's at right now. But as you know, the stock market goes up and it goes down. So if you're going to put any money into these sorts of investments, you need to make sure you're not going to need this money for the short term and that you're leaving it there for the long term. The only way you can really lose money in the stock market is if when a stock goes down, you sell it instead of waiting for it to go back, aside from a company going bankrupt or something like that. But if you're investing in companies that are strong and that you really believe in for the long term, then as long as you don't touch it when things go down, you're going to see a gain on your money instead of the loss that you're going to see if you just put it in a savings account and have inflation take its course. If you've never invested before and you're interested in starting, I'll link to a video right here that's from a little while back, but it talks about one of my favorite strategies for beginners who are investing. And also down in the description, there's a link there where you can click it and you can open up an investment brokerage account at a company called Wealthsimple that I quite like. If you use that link right there, you'll get $10 extra to go towards the trades that you're going to make in that investment brokerage app. It's super easy to use. Also, if there's somebody that you know that you love or care about that you think could really benefit from learning some of this stuff, make sure to hit that arrow button down there. That's the share button. And you can send a link to this video so that they can watch it too and figure out how they can protect themselves against the devaluing of their money by inflation. And if you personally found any value in this video, make sure to hit all those buttons down there, like, subscribe, the notification bell, all that good stuff. I'm bringing updates like this that can significantly help Canadians and their money, and so they can set themselves up to live a more financially stable and wealthy future. And with all of that said, thank you so much for watching, everybody. I really hope this information has helped you out at least a little bit, and I'll see you next time.